So, a very warm hello from Alan Waxman from Landmass. We're prime London residential designers and developers, and based in Soho, just off Regent Street in London. And I'm going to now share with you some information, some questions, and some answers. I'll be doing both, so please bear with me, and hope you find it interesting. Clearly, after this, feel free to get in touch, and if I can be of any service, then look forward to helping you. So, the purpose of this talk, or the title, is the role of joint ventures in development, primarily, of course, residential development. Um, the first question is, how do you first enter the development sector? So we all start in different ways. For me, it was actually buying some properties to rent out. I then found I could give a lick of paint, sell for a small profit. And then I decided to buy things specifically to renovate and sell. And you may not immediately appreciate how clever I am, but on my first major project, which was 2 floors above an off license in Fulham, in London, I only had to move the location for the kitchen 3 times. So clearly, I was clever enough to realize that I did not know what I was doing, which is a good way to start in this business, as anybody starting is always going to have to learn as they go on. The question is, how quickly do you learn? I then, when I finished that particular project, I got a Feng Shui specialist to come and check it, and she was happy with it. And fortunately, we then went on to sell it for record price relative to the market at that time in Fulham. And after that, I went to buy 2 properties in Notting Hill. They were 2-bedroom flats, and I did something strange for a developer. I changed them not into 3-bedroom flats, as a lot of people would have done, but actually back into 1-bedroom, because I felt the space worked better. Sienna Miller, the actress, bought one, somebody else bought another. And again, relative to the market, we got record prices. So that's how I started, and everybody will have a different story to tell. The next question is, can you give a brief overview of Landmass as a developer and your other operations? So as a developer, we've done 34 projects to date. The last 3 things that we've sold have been between 5.5 and 7.5 single units. And what happened was, a few years ago, we did one project in Belgravia in central London. And this was a mews house. Mews houses in the old days were used for the horses. And this property just had windows at the front of the property. So in order to turn the negative to a positive, which is clearly one of the games for a developer, was to take out a rear corner of the property and then put a 10.5 meter waterfall going down to a Zen garden. So it's a little bit like a TARDIS in Doctor Who. From what you saw on the outside was very different to what you saw on the inside. And you can see visuals of this on our website. I met with Nicole Kidman, the actress. She was going to buy it. Then she, lucky for her, she got pregnant, changed her mind. But with this project, and we had agreed terms, etc., it then ended up being bought by a French finance specialist. But on this project, we won Best Interior Design in the country, Best Development in London. And on the back of that, people then came to me and said, Alan, we like what you do. Could you do our own homes for us? So at that point, we also started running alongside our development side a design service for initially private clients, but that then led on to doing work for other investors and other developers as well. So on the services side, we have our own architectural interior design studio, which is where I'm doing the video from. And we're registered with the Royal Institute of British Architects as an architectural practice. We're very comfortable doing grade 2 properties, which obviously have a few more challenges. and then we can also source properties for investors who want to build up a portfolio of rental properties. Our area of expertise is prime London. So the thing about prime London is on the rental side, the yields initially are lower than in the provinces, but on the plus side, the capital appreciation is generally stronger. So horses for courses. We also offer an advisory side to investors, other developers, family offices, and often get involved in what I call troubleshooting. What I mean by that is you sometimes get people who have bought properties and they are not quite familiar about what they should be doing. The reason for that is experience and expertise. And I liken it to this little example about the dog. So the dog has a tail, and either the tail is wagging the dog or the dog is wagging the tail. What I mean by that, you sometimes get investors or new developers who bring in a whizzy design architectural team who then tell them what they should have. And what happens is when the end product comes to market, the agents say, well, why do you do that? And why do you do this? And often it's because the interior designer or the architect has had their own ideas about what they should have, and it's not fit for market. I was once looking at some plans done by a lady coming for an interview, and she showed me her past portfolio, and I was looking at details of a flat in Fulham, and looking at the bathroom. I said, well, what is that in the bathroom? Is that a shower or a bath? And she said, no, it was a jacuzzi. So I said, well, why did you put a jacuzzi in a two-bed flat in Fulham, which is, pretty ordinary area in London? And she said, that's what the architect wanted, right? So, the chances are when they try to put it on the market to sell, I guess most people would have had to rip it out to make it of practical use. Anyway, just a small example. Then the next question is, how do you find joint venture partners? Can you give advice to other developers? This is obviously one of the big hurdles for a lot of developers, and nobody can say it's easy. Obviously, networking in the right places, presenting your information in the best way possible, doing your appraisals, taking into account of all the different attributes. So if an investor looks at it and they pull it to pieces, you're not going to have egg on your face. The best thing is obviously to be belt and braces. Another way of attracting investors is what I call thought leadership. I don't actually like the expression thought leadership because it sounds a bit pompous, but basically, doing from your own database or on LinkedIn, social media, commentary about the market. So people then see you as somebody who is familiar with the market, knows what they're talking about, and that creates trust. And if they're thinking of doing something, they're the sort of person they would perhaps want to go and discuss with. So different ways, and but it is time consuming. The other thing to remember is it doesn't happen overnight. I think you have to visualize having 4 hobs on your hot plate at home, and imagine one is cold, one is tepid, one is warm, and one is hot. You can't go from cold to hot. You have to build up that relationship when you meet them, go from cold to tepid, tepid to warm, warm to hot. It is relationship building. Then the next question is, how do you structure your JVs? Well, that's a very good point, and there's various things to think about. First of all, from the investor's point of view, it's all about risk and forgetting how you structure it. You know, are they comfortable with the whole project, the numbers, and most importantly, not the profit, but the break even, because as my father used to say, always think what's the best that can happen, but always think what's the worst that can happen. And every investor needs to be comfortable that the break-even number is something that they feel is comfortably attainable. Making a profit, of course we want to make the profit, but we don't want to lose money. So structuring it, we would look to set up a special purpose vehicle for each project, normally onshore. If the investors are from overseas, then we can look at doing it maybe in Jersey or Guernsey or one of those offshore places for help. The second thing is within the SPV, we look to have two types of shares. A shares, which is in relation to the ownership, which go to the investor, and then B shares, so that we are seen as being part of the company without any ownership, but part of the team to execute the project. The main reason for that is out of the profit share to then avoid having to put an invoice in, which is obviously chargeable to VAT, and saving the VAT on any profit share, as in essence that would be money flushed down the toilet. So that's the advice of my lawyer, and obviously take your own advice to see how you best want to set it up, but that's the simple way that we look to do that. And the other thing, of course, with the investor having ownership, it gives them, again, further comfort. So the next question is, what sort of returns do you aim for when developing with a joint venture partner? So first of all, returns have to be in relation to risk. And in the area where Landmass operates, which is prime central London, generally speaking, it's a lot more competitive. Margins are a bit tighter. So it is harder to source the project and harder to get the returns for the investor. Having said that, we look to target a 20% annualized return for the investor. We make that up out of a priority payment of X% and then a share of the cake at the end. In simple terms, the shorter and fatter the project, the less we need to give away. The longer and leaner the project is, the more we have to give away. But that is the amount of terms that we look to offer. We don't look to put in numerous hurdle rates. Some people like to do that. We like to keep it really simple so that there's complete alignment with the investor. There's no conflict of interest, which is always a fear for any investor and developer as well, that you're all aligned. The reason why I say that is I know of a story of a developer having different hurdle rates, and it all looks nice on paper. The more that you sell for, the more share of your profit you get. But what happened was they got an offer on a very large house in St. John's Wood, and the developer persuaded the investors not to accept it because it came just below a hurdle rate. The sad news is it eventually got repossessed by the bank. Obviously, if they'd taken that offer, things would have been very different. So alignment with the investor is so important. The next question, pretty important: how do you maximize the returns? So there's an old adage in property: you make your money when you buy, when you sell. there's a lot of truth to that. You don't want to overpay and then say, well, it's not going to be a problem because the market's going to increase over the next 3 years, so we're going to be okay. Never fall into that trap. And what's essential is whatever numbers you produce in relation to sales figures are based on present day values and nothing to do what you could or couldn't do in the future. And of course, also within our appraisals, we do a sensitivity analysis. What happens if we sell it for 5% less or 10% less, and vice versa, 5% more or 10% more? It's good to have a good understanding of how things can fluctuate. So in relation to making your money when you buy, the acid test is the bank's red book valuation. And I can't say I'm the best developer in the world, but one thing I have a 100% track record on is when I've looked to buy a property is always getting the bank's surveyor to do a red book valuation that matches our purchase price. So what I mean by that, I've never had to cajole a surveyor to inflate it or take them out for a nice lunch in order to get the money from the bank, because at the end of the day, if you have to do things like that, you're only postponing something that bad's going to happen in the future, and you better not be better off not buying it. And it's important to have total comfort on that. And also, it's a very good acid test for any investor wanting to work alongside you, because they're not just getting your opinion, but they're getting a professional valuation surveyor's opinion as well. When we're looking at a project, there's three numbers that we're interested in. One is what can we sell it for? The second is how long is it going to take? And the third is what's going to cost to sort out. The way that we analyze those numbers on the sales value, I like to talk to established agents in the neighborhood. Comparables are fine, but each property is different. You've got to have proper conversations with people in a discreet, discretionary style to get a proper feeling of what you're going to be able to sell that for, warts and all. The second thing, timeline and costs. So there I initially have my own ideas, but then I work very closely with one of my project managers who has obviously a lot of experience at this type of thing, to then look at the timeline and the costings. Timeline is super important because obviously it affects your interest costs to the bank, and of course the investor's IRR, and the costs, again, what you want to make sure that they are robust. I use the word robust rather than conservative. I always think when people use the word conservative, they're being anything but conservative. It's a bit like when people say they'll definitely be there and they never turn up. So that's my initial thoughts. If we then dig down further on the costs, what's important there, again, depending on the type of thing you're doing, but in central London, bang for your buck. It might be better to spend extra money to get a better finish rather than try and cut your finishes and then not get the purchase price that you're looking for. But it's horses for courses. Other markets out of London, which are a lot more cost sensitive, there you have to stick to very strict parameters, because the budgets are tighter from both the purchaser and of course the investor, depending on obviously the project, but there's a ceiling on what you can sell it for, even if it has gold taps. The other point is, again, I'm speaking a bit more about central London, is what I call bang for your buck. So what's important is, obviously not to waste money, but to get good value and to how to spend it. For instance, in a bathroom, we may not tile the whole bathroom, not because we think it's a good way of saving money, but less is more. It may have a greater impact on the visualization of the bathroom, and that you can see from some of the work that we've done in the past. Pardon me. The other thing is super important is layouts. Now, layouts are the backbone to every good design. It's the flow of the space. And it doesn't matter how good the finishes are, if the layouts are no good, in my view, it's still rubbish. And the lengths that we go to get the layouts right are enormous, because it's so super important. It doesn't matter whether you're doing a single unit or a multiple unit. It's important, whether it's high budget or low budget. It doesn't matter whether it's Bradford, Brixton or Belgravia or Bournemouth. The layout is just as important, and it's not cost sensitive, unless of course you're doing a refurbishment where you have to knock down a lot of walls, but that'd be probably more in a high value area. The ways that I go to ensure upon that is, for instance, if I'm interviewing somebody for a job as an architect or a designer, of course they come with their beautiful portfolio, and you may have had the same experience before, but what you want to know is, how do they think? So I give them an unmodernized property to come back to me a week later to show me how they'd reorganized the space. And you'd be surprised how some people don't have the inspiration ideas that you'd wish them to have. So finding good people to work with on that side is super important. The other thing is, when you come to sell, again, it depends on the area. Some people, it could be a practical purchase. In other areas, it can be an emotional purchase. In central London, nobody needs to buy or rent anywhere. They already have a roof over their head. It's a luxury. So unless you're going to tick those boxes, you're going to have an issue. And so if you want to attract the right buyer, they've got to want to buy it. So it can be smell, touch, audio, bill, taste, and of course visual. And you have to touch into each of those points in order to give the whole holistic approach to entice somebody to want one of your properties. Nobody needs to go into Louis Vuitton on Bond Street. They can go to H&M. Why do they go into Louis Vuitton? Because first of all, they have the money, and secondly, they want the experience. And the same is with high value properties. They've got to want it. But if they go to Louis Vuitton and they see a bag they like but it's the wrong color, they don't ask the salesperson for a discount. They say, what else do you have? And if they don't have what they want, they go next door to Gucci or whoever. Okay, so it's they don't say to the agent, would they take a discount? They say, what else do you have? So it's very, very binary. We then go on to another question. What are the main risks with prime development, and how do you manage those risks? So that's a really, really important point. Before I answer that question, I want to just give you a little example. Imagine that you're a luxury car producer. What we do is similar to what they do in the car industry, with one exception. In the car industry, they're looking to design and manufacture a new car, but the difference is we have to build it in an old factory, whereby in their factories you can probably eat off the floor. And the main thing that they have that we don't have is a prototype. They can sort out all their problems on a prototype first before they go into production. We can't do that. So because of that, during the process, you may well have obstacles, hurdles, challenges, issues to sort out, and that's why you have a site meeting with the construction team. So how can we minimize those risks and manage them? First of all, having a very good team, right? Don't cut costs, on saying that you don't need, in order, for instance, to manage the contractor, you need to have three skill sets: a quantity surveyor, a good project manager, and then somebody doing the contract administration. So that can, in a smaller project, be one of those two. On a bigger project, a separate person. The contract is always changing with the builder, yeah, because there's always things that you need to sort out during the process. So you want to have a firm but fair relationship with the developer, with the builder, but to keep that on track, you need to have a good contract administrator. Then, of course, when you come to buy the property, if it needs planning permission, again, have the right team on board. And it's a lot to do with personalities. You can't have something where you have egos in the way, because otherwise it's not going to work out, because each step of the way there's lots of things to sort out. The next thing is, when it comes, if the project needs planning, do you have the right planning consultant? And also, a lot of people don't know about this, you may need a planning PR company, public relations. These are often ex-planners who can then talk to people on the planning committee, neighbors, other residents in the neighborhood, in order to flush out objections in advance and find ways of pacifying them. Because once you go to planning, you obviously want to make it as smooth as possible, and we all know you're going to have different hurdles. Then, of course, you have the financing. So again, to manage the risk, we do not look to use mezzanine finance. Why? On paper, it can look very attractive, but in reality, I find that if I was to do a project and have to put mezzanine in from the start, and if there's any renegotiation with the debt lenders, then you've got two people to deal with. You've got the senior debt lender and the mezzanine. Also, the mezzanine doesn't look to come in towards the end. They want to get stuck in at the beginning. So you're then committed to a very high interest rate right from the word go. If for whatever reason, as you come to the end of the project, you need top-up funding, then at that point you have three options. Either you can go back to your debt lender, who may oblige. You may need to bring in a small bridge, or you work out a solution with your joint venture partner. But hopefully that won't happen, but let's not pretend that it doesn't sometimes, so you need to be properly prepared for that eventuality. The other thing about managing risk is obviously to make sure that everybody's comfortable with the numbers from the start. And it's fantastic to be well challenged on the numbers and not to take that as a negative, but actually as a positive, because the more everybody's comfortable with the numbers and the more the joint venture partner is, then the less chance there is of halfway through or three quarters through something happening. And also in relation to the contractor, the builder, to make sure that your tender document, your designs are as tight as possible. And the worst thing you can see in these tender documents is TBC, to be confirmed, because that gives the scope for a builder to up the price, etc., etc., etc. So the tighter you can be on everything, much the better. Then the next question, why do you think that joint venture partners choose to work with landmass we assume is experience? ? So there's the obvious things that people can bring out as to why anybody would want to work with landmass. There's the track record, have they got the experience for those sort of things? Can they create the right product? bearing in mind that if they're doing stuff at the higher end, it has to be tip top. You can't cut any corners. We're lucky enough to have quite a good brand name, quite well respected in relation to the main agents in London. Reputation, of course, is very, very important, and of course your decision making on the type of site to buy, the design, following properly all the development of it, and especially overseeing the sale in the correct manner. But putting all those to one side, they're all well and good, and everybody will say, yes, we've got this, that, and the other. Personality. Can you get on with the developer? Can the developer get on with the investor? Is chemistry. You have to have that chemistry and that respect for each other, because remember that during the process you're going to have various decisions to make. And at one extreme, the investor may want to be very hands-on, and so they're going to be very instrumental in the design team, in the choice of the builder, the choice of the agent, coming to some of the site meetings, and then of course offers that you get. You may get another investor who wants to be very hands-off. Alan, you sound as if you know what you're doing, get on with it. But of course, even then, they still need to be aware. You need to have a very good development management agreement with them, so they're fully aware as the project progresses. And so if you've got things to discuss at critical times, they have the knowledge of what's happening. And especially when you come to sell, you get different offers. Do you accept? How do you handle those, or do you refuse them? So always decisions to make in conjunction with the investor. So that relationship is very, very important. Then the next question, how do landmass handle a soft market when sales of prime property is slow? Again, that's a good question. That happened to me back in 2016 after the last Brexit vote. The market went a lot softer, and I was exactly in that position. So what was my solution? My solution was to have a brochure designed which did not have any agent details on. So that way I was able to share it with different agents. I then had a sole agent who, if they were to sell the property, they were going to get 2.5%. And if another agent was to sell it, they would just get 0.5%. That enabled me to go to other agents and say, look, there's a great fee here. You can get 2%, but you can't put it on any of the social media. I only allowed the main agent to put it on the social media or the portals, Rightmove, Zoopla, etc., etc. That way, if anybody saw it online, they would only see one agent. They were, of course, able to put it on their own websites, which were private to them. So if anybody went onto their website, whether it was Savills, Knight Frank, Chesterton's, Foxtons, or whoever, they could then see it. And interestingly, in that situation, I actually found the buyer not from a Notting Hill agent, because the property was in Notting Hill, but from a Chelsea agent. How did they find the buyer? From one of their private contacts was a wealth manager in Zurich who had a client looking for a place in London. So often you never know where the buyer's going to come from, and the idea of having that umbrella but done in a controlled way, especially when the market's soft, super important, because also you don't want to over saturate the property, because then people will then come to say, well, what's wrong with it, etc., etc. So you need to do it in a very controlled and discreet manner. The next question is, can you tell us about Landmass Advisory Service for development projects? So here I've talked about the dog and the tail wagging the dog or the dog wagging the tail, and why do we get brought in by other investors or developers? Basically, it's a lot to do with troubleshooting, and they may be fantastic with their own spreadsheets and all the rest of it, but they don't have the experience to really understand what is necessary from the end product. So the way that we do that is basically offering them our advisory service. And a couple of examples, we had a client who had £30 million of stock to sell near Victoria in London, and it wasn't selling. And we were asked to go and have a look at it, and principally it wasn't presented properly. So they came over to see us. They said, "Can you help?" I said, "Yes." "And what do you suggest?" And my answer to that was, "I don't know." And they said, "What do you mean you don't know?" And what I said is, basically, until we've sat down with a selling agent and understand the profile of the buyer, how can we suggest what we should do? Because each market targets a different type of buyer. And interestingly, we got the instruction to do it. And on the first unit that we did in the block, we spent £30,000 on the furniture package, where previous designers had spent £60,000. They were there to sell the furniture, we were there to sell the flat. And it's horses for courses, but understanding how to get the product absolutely right. Another situation was on the much larger developer in the south of France. After 2 years, they'd only sold a quarter. And again, the way the whole building was presented needed to be tweaked, even from the front door, the showroom, the show flats, the whole shebang. So it's easy to look from an outside when you have the experience. It's not always easy to look from the inside if you don't have those sort of experiences. So, we are there to hold the hand of people who want to get involved, but want to make sure that it's done as best way as possible. The next question, which would you say is the most significant issue holding back wiser residential housing starts in non-prime? Is it planning or access to equity? It's got to be a combination of sourcing the right deals, the challenge of finding the investors, the equity, and of course then the hurdles with the planners. Each scenario is different, but if you think about the sort of things I've discussed, having the information done in a good way so that people understand it, to get the equity, being thorough on the idea of what you can in relation to planning, so that you feel that you've got a very good chance of getting it, and be aware of whatever hurdles might come across, and of course buying well. So those are my little tips on that situation. Then the last question, because we also have a design license in Monaco for interior design, and where we're also looking to get involved in development. And is there a big difference between developing in London and developing in Monaco? The main differences are, first of all, it's hugely competitive. So it's dog eat dog down there. People get a sniff, and properties go very, very quickly. Probably may think, well, it's not much different to where you're operating, but there is a heightened level. Secondly, finding deals at the right money is very difficult, and you need to act quickly. And in order to do that, you need to have your money properly sorted out. What I mean by that, in Monaco, if you make an offer, it's a legally binding offer. So there you need to have all your finances in place in advance, otherwise you can't make an offer. My partner in Monaco happens to be a property valuer. So he gets called in before people put it on the market. So those who are, I don't want to use the word distressed because it's Monaco, but who need to sell quickly and the property is not in a very good state, gives us access to, call it, undervalued properties, which are then worthwhile buying, redesigning and developing. The main difference, I think, in Monaco, because it's quite a controlled market, is risk. The margins may well be smaller, but the risk is a lot lower. And I think that factor is very, very important. And again, it depends on the appetite of the investor. I hope that summarizes and helps with what we've been, what I've been discussing. And just as a final point, I'd just like to say thanks to CapMes for organizing the expo. It was a pleasure to be able to answer all your questions, and feel free to visit our expo stand, and we're happy to go into more detail on specific projects and questions. So thank you very much for listening, and wish you every success in whichever endeavors you're looking to do. Cheers for now.